Welcome back to Stock Kong Invest and Analysis, where we look at the market and break down the opportunities.
Nvidia is flat, but not for long. Watch this boom.
Nvidia Corporation delivered strong Q3 FY 2026 results, with revenue up 26% to $57 billion and robust data center growth. NVDA maintains a dominant AI market position, justifying premium valuations despite a WDPE of approximately 40 times and price-to-book of 29 times. Key 2026 growth drivers include China's H200 chip market reopening and the Rubin platform launch, with potential for significant incremental profits. Risks include AI infrastructure overspending and potential sector-wide revaluation if AI profitability lags, but I reaffirm a strong buy rating. Nvidia Corporation, NVDA, reported solid fiscal third quarter 2026 results that beat market expectations. Revenue outpaced estimates by 3.48% to $57.01 billion. Moreover, adjusted EPS reached $1.30, which is 3.46% above what analysts expected. Since my previous analysis in late November 2025, Nvidia stock has gained just 3.7%, but it did beat the broad market's 2.62% return. These modest gains reflect the broader fears around AI spending and concerns about the AI bubble bursting that gained headlines during November and December 2025. Even so, several factors point to Nvidia moving higher in 2026. That, and for all the reasons outlined in this analysis, my strong buy rating for Nvidia remains in place. What's with Nvidia's fiscal third quarter 2026 earnings? In the most recent quarter, Nvidia's revenue rose 26% to around $57 billion, driven by the data center segment that brought in $51.2 billion of that revenue. Speaking of which, the data center's revenue increased 66% from a year ago, which tells us that the demand is still strong. That said, with all the fear around AI spending, fourth quarter figures of this segment would tell us a lot about the market's trajectory over the next 12 months. Meanwhile, gross profit for the quarter rose 60% to $41.8 billion, but gross margins actually dropped 1.2 percentage points to 73.4%. And that's for a good reason. Nvidia used to sell mostly individual chips, but now it sells complete systems. For example, when a customer buys a Blackwell NVL72 system, they're getting 72 GPUs plus all the essential equipment to run it, such as cooling systems, network solutions, and everything in between, all packed together. Indeed, these extra systems and solutions include parts that make less profit than their core chips. I'm not overly concerned about the margin decline. A gross margin of over 73% would be considered excellent for a software company, let alone a predominantly hardware company. Nvidia's operating performance was also impressive. In fact, operating income rose 65% to $36 billion compared to the same period last year. Moreover, net income also increased 65% to $31.9 billion, or $1.31 per share, basic. As for the balance sheet, Nvidia's cash and cash equivalents rose 40% to $60.6 billion with minimal debt. If we look at the bigger picture, the company's total assets reached $161.1 billion against total liabilities of just $42.3 billion. With these figures, you know that Nvidia's balance sheet is quite healthy. In terms of cash flow, Nvidia's operating cash flow rose 40% to $66.5 billion, while free cash flow increased 36% to $61.7 billion compared to the same period last year. This tells us that Nvidia is now more efficient at converting sales into real money. For the following quarter, management expects revenue in the neighborhood of $65 billion, give or take a couple of percentage points. Even at the lower end, that's still a continued strong momentum. Moreover, gross margins are expected to land around 74.8%. If it materializes, it would mean margin stabilization, and we might even see higher margins in the following quarters as Nvidia gets more efficient at producing these large-scale systems. How does Nvidia's stock and valuation look? At the time of this publication, Nvidia trades at approximately $188 per share. Over the past 6 months, the stock has gained approximately 10%, while the one-year return is around 42%. Quite modest, but when you look back 5 years, you'll see gains of nearly 1,300%. Now, is NVDA stock expensive? Well, it currently trades at a forward PE ratio, gap, of approximately 40x. It means investors are paying about $40 for each dollar of Nvidia's annualized earnings, which is about 26% above the sector. A 26% premium might not raise many eyebrows, but Nvidia's FWD price-to-book ratio stands at 29x, which is around 500% higher than the sector median. This means investors are paying approximately $29 for every $1 of Nvidia's book value. Sure enough, these valuations look expensive compared to traditional tech companies, but Nvidia surely isn't one. Think these valuations might look absurd for some companies, but not for a company with such a dominant position in the AI market. In fact, it sits at the center of the biggest technological revolution since the internet went mainstream. There were even industry reports claiming that Nvidia held 90% of the AI market, and these competitive edges deserve premium valuations. Moreover, traditional metrics don't fully capture the picture when a company dominates a market. For example, Nvidia's CUDA software platform became an industry standard, and developers around the world know how to write code for Nvidia chips, which then creates significant switching costs. So even if a competitor develops a slightly better chip, customers won't easily switch, since their programs are built for Nvidia. The point is that these are just some of the factors that can't be included in those traditional valuations that keep many investors awake at night. Most importantly, Nvidia releases chips that are exponentially more powerful with each new version. We had Hopper GPUs, then came Blackwell, and now Rubin is coming in the second half of 2026. Each generation offers leaps and bounds in better performance, which makes old models and alternatives less attractive. Also, it keeps competition playing catch-up and feeds the upgrade cycle flywheel. Going back to the stock, I think today's prices make sense at the current level for long-term investors, those with an over 5-year horizon. Although the long-term picture is pretty solid, I still expect near-term volatility as markets react to AI spending news. What are Nvidia's potential growth drivers in 2026? Despite the not-so-bullish sentiment at the end of 2025, I see several factors pushing Nvidia higher this year. The most immediate ones being China market reopening. On January 13, 2026, the Trump administration officially approved exports of Nvidia's H200 chips to China, essentially reversing the restrictions that shut Nvidia out of the world's second-largest economy. This restriction lift was followed by more than 2 million H200 chips orders at approximately $27,000 each, all from Chinese tech companies. According to the reports, the first shipment of about 80,000 chips should arrive in mid-February 2026. For the foreseeable future, no other Nvidia chips are allowed to be exported to China, which is why the company is ramping up H200 production, even though we're moving to the newer Blackwell and Rubin platforms for most markets. But there's a catch to this restriction lift. Actually, several catches. For example, the US government takes a 25% cut of these sales. So instead of getting $27,000 per chip, Nvidia nets about $20,250. That brings potential revenue down to approximately $40.5 billion on those 2 million chips I mentioned. Also, China can't buy more than 50% of what Nvidia sells to American customers, and Chinese buyers must prove they have security procedures and promise not to use the chips for military purposes. To me, the uncertainty is what Beijing will actually allow. There were reports about Chinese customs officials blocking H200 imports, and the government telling Chinese tech companies to boycott H200 chips unless absolutely necessary. Now, if you look at the top view, this shows an internal conflict for China. They want the best AI capabilities, but they also don't want to depend on America and build their own chip industry. Some industry reports even suggest that China might only approve university research purchases under special conditions, meaning the commercial market might still be largely blocked for Nvidia. In my best-case scenario, where Beijing allows most orders to go through, we can calculate the financial impact. Considering Nvidia's 73.4% gross margins, that gives us about $29.7 billion in gross profit, if that $40.5 billion potential revenue materializes. After operating expenses, this could add roughly $26 billion to net income, over the next 12 to 18 months as it fulfills orders. Again, Nvidia made $31.9 billion in net income in the most recent quarter. So China could easily add a full quarter's profit if everything goes right. But of course, that's quite a rosy scenario. Now, let's say, to be more realistic, Beijing approves maybe 20% to 30% of the orders, as it requires Chinese tech companies to buy chips from domestic players like Huawei. In this case, we might see $8 to $12 billion in net revenue and $5 to $8 billion in added net income. Although it's not as explosive, it's still a meaningful addition to Nvidia's bottom line figures, which generally affects the stock's trajectory. Rubin platform launch in H2 2026. Another potential growth driver of Nvidia is its Rubin platform. The company announced it at CES on January 5, 2026, and the platform appears to be a significant tech upgrade that should keep Nvidia ahead of the competition. Nvidia claims that Rubin cuts the cost of running AI models by 10x compared to Blackwell. The platform also needs 4 times fewer GPUs to train AI models. All good news for customers. If you're running AI services, your computing bills could decline by 90%. Even just 15% savings from efficiency translates to hundreds of millions if you're spending billions for AI infrastructure. In fact, hyperscalers have already committed to Rubin. Tech giants like Microsoft Corporation, MSFT, Alphabet Inc., Google or Goog, Amazon.com Inc., AMZN, and Oracle Corporation, ORCL, will deploy Rubin in the second half of 2026. Meanwhile, AI companies like Anthropic, Anthro, Meta Platforms Inc., Meta, OpenAI, and others publicized plans to utilize Rubin systems for training next-generation AI models. Now, if Rubin reduces inference costs by 10x, I see this playing out in 2 ways. Either Nvidia sells fewer chips because customers need less hardware now, or the market expands significantly as AI becomes more affordable for many applications.
I think the second scenario is more likely, considering Jevons paradox. The more efficient something becomes, the more of it we use.
If Rubin captures 60% to 70% market share of the high-performance chips through 2028, the platform could generate $150 to $200 billion in gross profit. Considering the current 73% margins and after operating costs, that would translate to between $120 and $160 billion in net income, again, through 2028. That said, the actual numbers will always depend on whether Nvidia can maintain the momentum throughout. What are Nvidia's potential risks in 2026? But of course, there are risks to Nvidia's business. In fact, I've noticed quite a few, but I will only focus on the most immediate one. In fact, Deutsche Bank Aktiengesellschaft (DB) said it expects OpenAI could burn through $143 billion between 2024 and 2029, before crossing the bridge to profitability. Now, OpenAI announced going public in the second half of 2026. When that happens, we will get a clear look at the company's economics. And if those numbers look bad, it could trigger a wide reassessment of AI valuation across the entire sector. If Deutsche is right, we can expect another round of AI stock sell-off, which will ultimately affect Nvidia. Moreover, the Goldman Sachs Group Incorporated (GS) projects that the largest cloud companies will spend $527 billion on AI infrastructure in 2026, which is a notable increase from about $400 billion in 2025. These companies are the same hyperscalers buying millions of GPUs. According to Goldman's analysis, these investments need to generate over $1 trillion in annual profits to justify spending, but estimates for 2026 show these companies making only about $450 billion. That's a significant gap. This creates an air pocket. Companies keep spending billions of dollars, expecting that AI applications will eventually pay off, but tangible revenue lags behind. I mean, we've seen this pattern before. The railroad boom in the 1870s, the dot-com bubble, the telecom build-out in the 2000s. Each time something justified a massive investment, but each time the industry overshot and went through painful corrections before actual value was realized. In a bubble-bursting scenario, Nvidia's stock would likely suffer. Investors might value the company at below 20 times forward earnings instead of the current 40 times. Factor in slower earnings growth into the mix, and the stock could drop further, even if the company executes well operationally. My verdict on Nvidia: Despite the risks around geopolitics and the AI bubble, I am still positive on Nvidia. Also, if you've read my disclosure, it does not say I own NVDA stock. Actually, I own an outsized portion through a fund, one of which I have no plans to sell. After all, Nvidia dominates what could become the most important technology of the next decade. And management has consistently executed well. Product releases keep competitors behind, and Nvidia's CUDA ecosystem serves as a competitive moat that's practically impenetrable. With everything outlined above, my strong buy rating for Nvidia stays in place.
Hey viewers, don't forget to like, subscribe, and add our channel to your favorites. We will continue to provide you with more insightful stock analysis.